Hi, I'm John Hull. I teach in the business school at the University of Toronto. It's called the Rotman School of Management, and my area of expertise is derivatives and risk management. Well, I think derivatives markets have always been reasonably efficient. So I wouldn't say efficiency was necessarily the key aim. But if we think about derivatives markets, there's two, as everybody knows, there's two different derivatives markets: the exchange-traded derivatives market and the over-the-counter derivatives market. The over-the-counter derivatives market has, over the years, become a lot bigger than the exchange-traded derivatives market. And up to the crisis, it was largely unregulated. So I could get on the phone with you and do a deal. It would just be a deal between you and me. Nobody would know about it except the two of us, and we would have a master agreement in place to manage that and other deals that we've done between ourselves. Largely as a result of the credit crisis that was sort of 2007, 2008, 2009, that's all changing, and we're seeing regulations for the over-the-counter derivatives market. But I wouldn't actually say efficiency was the prime objective of the regulations. It'd be nice if the markets became more efficient. I think what the regulators want is the markets to become more transparent, so that people can see what trades are being done. I mean, the regulators never want to be confronted by another AIG situation. AIG was the big insurance company in the United States that wrote credit derivatives contracts that insured AAA-rated products that were created from subprime mortgages. And of course, we know a lot of those AAA-rated products went south. And it cost AIG a lot of money, and it cost the US taxpayer a lot of money when AIG had to be bailed out. But the key thing there is nobody had any idea that AIG was always on one side of that particular trade. It was always writing protection against these securities created from mortgages, from residential mortgages in the US. So one of the prime objectives, I think, is transparency. They want to know what trades are being done. What we're seeing is the creation of swap execution facilities in the US. We're seeing the creation of central clearing parties for standardized over-the-counter derivatives, and we're seeing much more collateral in the system, and we're seeing central registers. So, I mean, obviously, if a trade goes through a central clearing party, then then it will be known about. There's no secrecy. But if you and I, there will still be some trades which are done like the trade I was describing earlier between you and me, that nobody else knows about because it's not a standard trade. It's not a trade that can go through the central clearing party. But we will be required to register that trade with a central register, which is different from the situation before.